guys doing? So we are over here today, with Peter Karlin from Jet Direct. Okay, we shoot a video. I believe it was last week. It was regarding the mortgages, and we had a great response from people, and a lot of people actually had a lot of questions. So we want to go with Mr. Karlin a little bit more into detail on how the bank exactly calculates, how much of a money they will actually lend you for the mortgage. So Peter, thank you very much for being with us online today.
Pleasure.
So how the banks exactly determines on how much the buyer will get for the house? What do they look for?
Okay.
What are some of the setbacks?
Mm-hmm.
And sort of, what is the process? What do you do?
Okay. Well, I'm going to talk about, because as I said in my last week's video, there's a number of factors. There's the credit, and there's your income, and how much money you're putting down. But today I want to talk about something called debt-to-income ratio. Right? People will frequently say, how much will I qualify for? I make such and such amount of money, and how much will I qualify for? So there's two major loan programs that most banks give in the United States. It's a conventional loan and an FHA loan. And I don't know am I going to get into that now? Do I want to talk about
We can probably leave that for another video.
Okay.
I think, it's better if we stick to the debt to income ratios. They will understand it correctly, exactly how does that work.
Okay.
And then we can break it down in the next session, I guess.
Okay. So again, we'll talk about the conventional and the FHA loans, which are probably the two most popular loans in the United States at this point, in another video. But the reason why I bring those two loans up is because those two loans have different DTI, or debt to income ratio, factors that are associated with those loans. And normally if I need to give someone a loan, or they would need a little less stricter guide, a little stricter restriction, looser restrictions in terms of income, I'll lead them to, or present to them, or offer them an FHA loan rather than a conventional loan.
So the FHA, it's easier to qualify.
It's easier to qualify for, but quickly, an FHA loan is really for first-time, is really geared towards first-time home buyers in the United States.
Okay.
Right, first-time home buyers. So debt-to-income ratio. So here's how this works. It's a factor that the bank uses to calculate your qualifications. So for instance, I will tell you, on a conventional loan, the debt to income ratio is, you can't go, we have what's called a front end factor and a back end factor. Front end and back end. Front end is what's known as when you take your housing ratio and you divide it by your gross income. If you're a W-2 employee, rather, there's gross income on a W-2 employee, or net income if you're a self-employed person. So what we do is we take the housing ratio. So let's say, for instance, your total all-in mortgage payment might be, for principal, interest, taxes, homeowners insurance, and potentially mortgage insurance, let's say it's $3,000, right? So $3,000. So if you take $3,000 and you divide that number, I'm going to get my calculator just so I make sure that I'm doing this right as I'm talking to you.
So they just calculate the cost, the expense from the property, basically.
Right. So you
the mortgage you sent, is the taxes.
It's the principal, interest,
okay,
property taxes, homeowners insurance, and then if you're under 20%, if you're putting down less than 20%, it's normally 20%, then you're also going to have to pay mortgage insurance, unless of course the lender pays mortgage insurance, which we call lender paid mortgage insurance. Okay. But we're not going to get into that now.
How about the, let's say, the utilities expense? Let's say the
utilities,
water, electric.
That's all, has nothing to do with the mortgage.
They don't take that into consideration.
We don't take that into consideration for the debt to income ratio. Debt to income ratio takes two things into consideration. It takes into your housing expense, which is the five things that I just mentioned.
Okay.
And it also takes into account the expenses that are listed on your credit report. The expenses that are listed on your credit report. Unless you have an expense that's an ongoing monthly expense that's not listed on your credit report, but you may show it as something that's taken out of your bank statement or something like that, then we'll include that as well in your debt to income ratio. But as I was saying before, we have something called a front end and a back end.
So the front, you said, is just...
Front end is just the mortgage payment.
Okay.
We call it the housing expense.
Okay.
It's just the mortgage payment divided by your total income. So for instance, if let's say you make $100,000 a year, let's divide that by 12 because there's 12 months in a year. That's $83.33 a month, right? So $83.33 a month. Typically, your front end and your back end ratio for a conventional loan should be less than 45%. So if I take the $83.33 that you're making gross income as a W-2 employee, and I multiply that by 0.445, let's say, 44.5%, keep it under 45, then that number is 3708, which means that your mortgage payment should not be all in more than $3,700. Okay?
In order to qualify.
In order to qualify
for that loan.
Correct. Now let me say this. There is some flexibility with debt to income ratios. Okay? Sometimes with a conventional loan, I have seen and my coworkers have seen where we can go up to 49%. Actually go up to 49%. But it's depending upon if a computer system that we use for Freddie Mac or Fannie Mae will give you the okay. So it's not like a blanket number I can give you. I could tell you it has to be less than 49, but it has to be looked at by the computer system.
I understand.
But normally anything under 45 on both the front and the back. It's funny because I just spoke to someone who I work with today. My branch manager said 45 front and back. I always thought it was 43 on the front. Again, the front ratio, remember, the front ratio is the housing ratio, whereas the back end ratio is your monthly debt. It's your housing plus the debt on your credit report or these other payments, right?
So you have to qualify for both.
You have to qualify for both, right?
Okay.
So there are both of those numbers. So if you just quick and dirty, right? If you just want to figure out how much you can afford. And there's two things, right? It's not only affordability, but it's your comfort level. I frequently, when I sit down and I speak with people, I say, hey, what do you may qualify, right? You may qualify for $3,700 a month, but are you comfortable paying $3,700 a month? You may say,
you might have different expenses.
And it's a personal thing. I can't make that determination. You do. And by the way, when I just a side note, when we talk about co-ops and condos, more so co-ops, they make up their own debt-to-income ratio qualifications. I just heard the other day...
The board itself.
The board itself. I just heard the other day, I couldn't believe it, I never heard anything this low.
About 30%.
28, I heard it, in one particular building. They want to see that, not your front-end ratio, but your back-end, your all-in expense has to be less than 28, which I thought was very
and so
restrictive.
The back end ratio. So let's say the front end, we have that handled, but let's say the back end ratio. Let's say they have a credit card debt, so they have a student loan or car loans, right? So what do they look for? Let's say I have a car loan. I own $20,000 in the car.
Okay.
My monthly payment is $500.
Okay.
So how do they calculate? Do they go with the total debt and they
No. We only good question. That's a great question.
Okay.
So we only care about your monthly debt, right? That's all we care about.
But I mean, the credit card debt can be monthly anything I want to pay, right?
No, but that's another good question. So it's not what you pay, but it's what's listed on your credit report as the minimum monthly payment, right? So on a student loan, it's the only thing that there's a couple of things that give a little flexibility, or I don't want to say flexibility, but if on a student loan you're not seeing, sometimes they don't list the minimum monthly. So in that case, I believe, don't quote me, I'm not 100% on this. I think it's 1% of the amount that you owe. So if it's 20,000, right? So it's
like $200.
Exactly. It'll be $200. So just 1% on that, and then there's another. If you have less than 10 payments left on a car loan, not a lease. Leases, by the way, very interestingly enough, a lease, if you were under 10, it doesn't matter. You get hit with that because leases assume that you're going to be leasing again, right? You end the lease and you lease again. But if you're under 10 payments on a car loan, then the bank doesn't have to include. They include those payments on your. Yeah.
And so, what else you think? The buyer.
Here's another thing.
When they're qualifying for a loan, what do you think they should look out for?
I'm sorry.
Another thing you think there's something they should account for, qualifying for a loan, something, so you said the front end, the back end.
Right.
Anything else would sort of deteriorate, the qualifications on how much they can get from the bank?
Right. Well, you always want to, I'm a big fan of, and I think I mentioned this in the last video that we did, running your credit at least once a year, right? You want to see, you want to check to see if there's stuff that's on your credit report that doesn't belong to you. There's stuff that's on your credit report that...
A lot of people, they're afraid of running credit because it's going to lower the scores,
right? Right. So
it's a very common thing we get all
yes.
the time from buyers. Please don't run my credit
exactly.
because it's going to lower the scores.
Correct.
And,
Correct.
They think if my scores is lower, my rate will be higher. I don't know.
No, you're 100% right. I'm glad you brought that up. So here's the thing. Does running your credit lower your score? Yes, it does. Does it lower it significantly? Usually not. Usually from 2 to, let's say, I'm going to guess 7 or 8 points. And it's really dependent upon a number of factors how it lowers your score.
Okay.
Like if you're someone who's run your credit a lot, different like Macy's and different entities have run your credit in the last.
They apply for
right. If you're a credit shopper
okay.
and you run. The more you do it, yes, it will impact you more. But if you have decent credit and you run a report once or twice a year, maybe you'll get hit 2 to 5, 7 points a reduction. But here's the thing: you need to run it. You want to run it. You want to see what's going on.
That's right.
Right?
You don't know if there's maybe something that doesn't belong to you, right?
Something that doesn't belong to you, or something that you can fix before you apply for the loan. Because here's the thing. Once you apply for the loan, once you put an application in, we can't now fix your credit to make it better, to get you a better score, to get you a better interest rate. We can't do that.
So whatever the score is,
whatever the score is at the beginning of the loan application and we submit, that's what you're stuck with. Unless there was a mistake on the credit report and we can fix the mistake, and then the bank will take that into consideration, that it was a mistake. Or the other time that it happens is if the credit expires. Let's say it goes past, I think, I should know this, I apologize, don't hold it against me. I think it should be about, a credit report is good for 90, it's either 90 or 120 days, I forget. So once we have to run the report again, we take the scores on that time. So
if updated one, basically.
From the updated one, right. So if you drop,
and if you improve,
if it improves, you get the benefit of the improvement as well.
Good stuff. I mean, guys, again, this is Peter Karlin from Jet Direct. We're talking about how does the bank really determines on how much they're willing to give you of their money to purchase their house. And I mean, Peter, it's always a pleasure to have you. I mean, Peter is very knowledgeable. You do sell anywhere in New York, right? So if anybody's
New York and New Jersey,
you do refinance as well. If somebody
I do refinance, yeah, for sure.
And so you do residential and also commercial loans as well.
I do residential, commercial, yes, I do.
Okay. So why don't you leave them your information, so they can contact you, and you can contact Peter at any time. If he won't pick the phone, just don't be afraid to leave a message, or you can text him. Peter's very good through the text.
Yeah,
and
texting is actually a really good way to get in touch with me. If you want to shoot me a question or whatever, please feel free. My number is 917-684-6123. I'm not going to repeat it because you could rewind. John told me that.
That's right. And you can save it and you can play it over and over and over again till you get it. And guys, it's always a pleasure to bring you a valuable information. If you would like to see something, you get some questions, you would like to bring some topics, you would like us to discuss with Peter, let us know, let me know, so we can prepare for it as well.
That's a great idea.
And
send it to John or me. That's
right.
That'd be great.
And we'll be speaking to you guys next week.
Awesome.
Thank you, sir.
Thank you, sir. Appreciate it. Thank you, everybody.
Have a
Take
great
care.
day.
Hope that was education.